Question 10. How does Simplify Aggregate Bond ETF, AGGH's portfolio turnover rate compare to similar bond ETFs? Here's a detailed explanation of how Simplify Aggregate Bond ETF, AGGH's portfolio turnover rate compares to similar bond ETFs. AGGH's high turnover rate. Active management. Unlike passively managed bond ETFs that simply track an index, AGGH actively manages its portfolio. This means the fund manager buys and sells bonds strategically to potentially enhance returns or implement credit hedge strategies. This active trading contributes to a high portfolio turnover rate. Prospectus disclosure. The AGGH prospectus mentions a 400% portfolio turnover rate for the most recent fiscal year. This is significantly higher than the average turnover rate for bond ETFs. Comparison with similar bond ETFs. Passively managed bond ETFs. These ETFs typically have a low portfolio turnover rate, often ranging from 5% to 20% annually. They passively track a specific bond index, meaning they buy and hold the same proportions of the bonds in the index with minimal trading activity. Other actively managed bond ETFs. Portfolio turnover rates for actively managed bond ETFs can vary depending on their specific strategy. However, they generally fall between passively managed and AGGH's high turnover rate. Some actively managed bond ETFs might aim for a more strategic approach with a turnover rate closer to 50% or 100%, while others might be more active with turnover rates exceeding 200%. Implications of high turnover rate. Higher transaction costs. Frequent buying and selling in AGGH leads to potentially higher transaction costs compared to passively managed bond ETFs. These costs can include brokerage commissions, bid-ask spreads, and market impact costs. Higher transaction costs eat into the overall returns for AGGH investors. Tax considerations. Frequent trading in AGGH could lead to more frequent capital gains distributions, potentially resulting in higher tax liabilities for investors holding the ETF in a taxable account. Important points to consider. Compare turnover rates. When evaluating AGGH, compare its disclosed portfolio turnover rate to passively managed and other actively managed bond ETFs. Weigh costs and benefits. Consider the potentially higher returns that AGGH aims to achieve through active management against the increased transaction costs associated with its high portfolio turnover rate. There's no guarantee that AGGH's active management will outperform a passively managed bond ETF, even after accounting for these costs. Investment goals and risk tolerance. High turnover can be a red flag for some investors, especially those seeking a more tax-efficient and lower-cost bond exposure. However, others might be comfortable with a higher turnover rate if the potential for higher returns through active management outweighs the cost considerations. Question 11. What is the liquidity of Simplify Aggregate Bond ETF, AGGH, compared to other bond ETFs? Simplify Aggregate Bond ETF, AGGH, likely has moderate liquidity compared to some other bond ETFs, particularly larger and more established passively managed funds. Here's a breakdown of the factors affecting AGGH's liquidity. Factors affecting AGGH's liquidity. Trading volume. AGGH's daily trading volume is a key indicator of its liquidity. A higher trading volume suggests more shares are being bought and sold daily, making it easier to enter and exit positions without significantly impacting the price. While specific data isn't available here, AGGH being an actively managed ETF might have a lower trading volume compared to some widely traded passively managed bond ETFs. Underlying holdings. AGGH primarily invests in investment-grade bonds. These are generally considered liquid assets, but their specific liquidity can vary depending on the credit quality, maturity, and issuer. Less common bonds within the portfolio might have lower liquidity, potentially impacting the overall liquidity of the ETF. Market maker activity. Market makers play a crucial role in facilitating trades for ETFs. They provide bid and ask prices, ensuring there are buyers and sellers available. AGGH's liquidity depends on the commitment of market makers to provide these quotes and the depth of the order book. Comparison with other bond ETFs. Large passively managed bond ETFs. These ETFs, which track popular bond indices, often have high liquidity. They typically have a large number of investors and high daily trading volumes, making it easy to buy and sell shares without significant price impact. Actively managed bond ETFs. Liquidity for actively managed bond ETFs can vary depending on their size and popularity. Some actively managed bond ETFs with established track records and larger asset bases might have good liquidity, comparable to passively managed funds. However, newer or smaller actively managed ETFs, like AGGH, might have lower trading volumes and potentially lower liquidity. Implications of liquidity. Order execution. Lower liquidity in AGGH could lead to slightly wider bid-ask spreads, meaning the difference between the price you can buy and sell shares might be higher compared to a highly liquid ETF. This can impact your order execution and potentially increase your transaction costs. Large trades. If you're looking to invest or redeem a very large amount in AGGH, you might face some difficulty due to its lower liquidity. It might take longer to execute the trade without significantly affecting the price. Question 12. How does Simplify Aggregate Bond ETF (AGGH) manage credit risk? What is the credit quality of the underlying bonds? Simplify Aggregate Bond ETF (AGGH) employs a two-pronged approach to manage credit risk while offering exposure to investment-grade bonds. 1. Core bond selection. Investment-grade focus. AGGH primarily invests in bonds issued by governments and corporations with high creditworthiness, meaning there's a lower inherent risk of default. These bonds fall under investment-grade ratings by major credit rating agencies like SP, Moody's, and Fitch. Credit quality spectrum. Within the investment-grade universe, AGGH might strategically select bonds. Higher credit quality. The fund might allocate a portion towards bonds closer to the AAA/AA end of the investment-grade spectrum, offering potentially lower default risk but also potentially lower yields. Balance and yield. It could also balance the portfolio with some bonds closer to the lower end of investment grade, BBB, to achieve a higher potential yield while maintaining an overall investment grade profile. 2. Credit hedge strategies, optional. In addition to the core bond selection, AGGH might utilize various strategies to potentially mitigate credit risk further. Credit default swaps, CDS. These are essentially insurance contracts where AGGH pays a premium in exchange for a payout if a bond issuer in the portfolio defaults. This can help offset losses if any underlying bonds experience downgrades. Inverse high-yield bond ETFs. By holding a small inverse position in a high-yield, junk, bond ETF, AGGH aims to potentially benefit if the junk bond market experiences a downturn. This could indirectly hedge against potential downgrades of some investment-grade bonds to junk status. Credit quality of underlying bonds. Investment grade. As mentioned earlier, AGGH focuses on investment-grade bonds. These bonds are considered to have a relatively low risk of default compared to high-yield, junk, bonds. Credit rating distribution. The specific credit rating distribution within the investment-grade spectrum for AGGH might not be publicly available on a daily basis. However, the fund prospectus or fact sheet might disclose this information periodically. Look for details on the percentage allocation across different credit rating categories, e.g. AAA, AA, BBB. Question 13. How does Simplify Aggregate Bond ETF, AGGH, manage the risk associated with using options and other derivatives? Simplify Aggregate Bond ETF, AGGH, utilizes options and other derivatives to potentially enhance returns or mitigate risks. However, these instruments come with inherent risks that AGGH tries to manage through various strategies. Risk management strategies. Selection and strategy focus. The fund manager carefully selects the types of options and derivatives used in AGGH's strategy. They might prioritize strategies with defined risks and limited potential for losses, such as covered calls. Position sizing and monitoring. AGGH likely employs strict position sizing limits to restrict the potential impact of any single option or derivative position on the overall portfolio. The fund manager also closely monitors the performance of these positions and adjusts them as needed to manage risk. Stress testing. AGGH might conduct stress tests to simulate how the portfolio would perform under various economic scenarios, such as sharp interest rate movements or unexpected market volatility. This helps the manager identify potential risks associated with the options and derivative strategies and take mitigating actions. Counterparty risk management. AGGH focuses on using options and derivatives from reputable counterparties with strong financial standing. This helps minimize the risk of losses if a counterparty defaults on its obligations. Transparency and reporting. While full details might not be available daily, AGGH should provide transparency in its prospectus or fact sheet about the types of options and derivatives being used. This allows investors to understand the potential risks involved. Limitations of risk management. Imperfect predictions. It's impossible to predict market movements with perfect accuracy. Even well-designed option strategies can experience losses if market conditions move unexpectedly. Complexity. Options and derivatives involve complex calculations and can be susceptible to mispricing. This can lead to unintended losses for AGGH. Hidden costs. Transaction costs associated with using options and derivatives can eat into the overall returns of the ETF. Question 14. How does Simplify Aggregate Bond ETF, AGGH, compare to other bond ETFs in terms of volatility? Here's a detailed breakdown of how Simplify Aggregate Bond ETF, AGGH, compares to other bond ETFs in terms of volatility. AGGH's potential for higher volatility. Active management. Unlike passively managed bond ETFs that track an index, AGGH actively manages its portfolio and uses options and derivative strategies. These strategies can introduce additional layers of complexity and potentially lead to higher volatility compared to a passively managed bond ETF. Options and derivatives. The use of options and derivatives can magnify both potential gains and potential losses. For example, writing call options might limit upside potential if bond prices rise significantly. Volatility compared to different bond ETFs. Passively managed aggregate bond ETFs. These ETFs typically track a broad bond index and aim to replicate its performance. They generally have lower volatility as they hold a diversified basket of bonds and don't engage in active trading strategies or use options and derivatives. Other actively managed bond ETFs. Volatility for actively managed bond ETFs can vary depending on their specific strategy. Some actively managed bond ETFs might have lower volatility than AGGH if they focus on a more conservative approach with minimal use of options. However, others employing more aggressive strategies or using options extensively might experience similar or even higher volatility than AGGH. Evaluating volatility. Historical performance. You can compare the historical standard deviation or other volatility measures of AGGH with passively managed and other actively managed bond ETFs. However, past performance is not necessarily indicative of future results. Prospectus and fact sheet. Review the AGGH prospectus or fact sheet to understand the types of options and derivatives being used and the fund's overall investment strategy. This can help you get a sense of the potential for volatility. Question 15. What are the potential correlations between Simplify Aggregate Bond ETF (AGGH) and other asset classes in your portfolio? Here's a breakdown of the potential correlations between Simplify Aggregate Bond ETF (AGGH) and other asset classes in your portfolio. AGGH, Investment Grade Bond ETF. Primarily invests in investment-grade bonds, which are generally considered less volatile than stocks but more volatile than cash equivalents like money market funds. Correlations with other asset classes. Stocks. Historically, there's typically an inverse correlation between bonds and stocks. When stock prices go up, bond prices tend to go down, and vice versa. This negative correlation can help balance a portfolio and potentially mitigate overall portfolio volatility. However, the strength of this relationship can vary depending on market conditions. Interest rates. Bond prices are inversely related to interest rates. When interest rates rise, existing bonds with lower coupon rates become less attractive, leading to price declines. AGGH, as an investment-grade bond ETF, might be more sensitive to interest rate fluctuations compared to high-yield bond funds. Economic conditions. During economic downturns, investors might flock to bonds perceived as safer havens, potentially driving bond prices up and yields down. AGGH, with its focus on investment-grade bonds, could benefit from this flight to safety bid in such scenarios. Cash equivalents. Cash equivalents like money market funds offer minimal volatility and returns. Compared to AGGH, they will have a much lower correlation with stocks and interest rates. Question 16. How concentrated is Simplify Aggregate Bond ETF (AGGH's) exposure to any single issuer or sector? Simplify Aggregate Bond ETF (AGGH) likely aims for a diversified exposure across issuers and sectors within the investment-grade bond universe. However, due to the nature of its active management strategy, it might have a higher concentration compared to passively managed bond ETFs. Here's a breakdown of the factors affecting AGGH's concentration. Active management. Unlike passively managed bond ETFs that simply track an index, AGGH actively selects bonds based on the fund manager's judgment. This selection process can lead to a portfolio with a higher concentration in certain issuers or sectors the manager believes offer attractive opportunities. Concentration analysis. Prospectus and annual reports. These documents disclose the holdings of AGGH. You can analyze the issuer and sector breakdown to understand the level of concentration. Look for the percentage allocation towards the top individual issuers and the top sectors represented in the portfolio. Fund fact sheet. The fact sheet, typically updated monthly, might provide a high-level overview of the issuer and sector diversification. This can give you a general idea of concentration without requiring a deep dive into the full holdings list. Comparison with passively managed bond ETFs. Passively managed bond ETFs that track broad bond indices inherently hold a large number of issuers across various sectors. This diversification helps minimize concentration risk. Concentration risks. Increased vulnerability. If an issuer or sector experiences financial difficulties, a concentrated exposure in AGGH can lead to potentially larger losses compared to a more diversified bond ETF. Limited diversification benefits. A highly concentrated portfolio might not fully benefit from the diversification advantages typically associated with bond investing. Question 17. How does Simplify Aggregate Bond ETF (AGGH) compare to other actively managed bond ETFs in terms of performance and fees? Here's a detailed breakdown of how Simplify Aggregate Bond ETF (AGGH) compares to other actively managed bond ETFs in terms of performance and fees. Performance comparison. Limited track record. Since AGGH is a relatively new ETF, launched in 2021, its track record might be shorter compared to some established actively managed bond ETFs. This makes direct performance comparisons challenging. Benchmarking. AGGH's prospectus might mention a benchmark index it aims to outperform. You can compare AGGH's historical returns to this benchmark to assess the fund manager's relative performance. Peer group analysis. Financial websites and research tools allow you to compare AGGH's performance against other actively managed bond ETFs within a similar category, e.g., core bond, investment grade. Look for metrics like total return, risk-adjusted return, e.g., Sharpe ratio, and maximum drawdown to evaluate performance. Important considerations. Past performance. Past performance is not necessarily indicative of future results. Actively managed bond ETFs rely on the skill of the fund manager, which can change over time. Risk-adjusted returns. Don't just focus on raw returns. Consider risk-adjusted metrics to compare how much return each ETF generates relative to the risk taken. Fee comparison. Expense ratio. Compare the expense ratio of AGGH to other actively managed bond ETFs. The expense ratio is an annual fee that covers the fund's operating expenses. A lower expense ratio generally translates to higher returns for investors, all else being equal. Management fees. Actively managed bond ETFs typically charge a management fee to compensate the fund manager. While not always explicitly disclosed, this fee is usually incorporated into the expense ratio. Hidden costs. Some actively managed bond ETFs might incur additional costs due to frequent trading activity or the use of complex derivative strategies. These hidden costs can further erode returns. Alright everyone, that brings us to the end of our deep dive into Simplify Aggregate Bond ETF, or AGGH. As a recap, AGGH offers an actively managed approach to bond investing, focusing on investment-grade holdings and potentially using options to generate extra income. This strategy comes with the possibility of higher returns compared to passively managed bond ETFs, but also introduces potentially higher risk due to active management and the use of options. Ultimately, the decision of whether AGGH is right for you depends on your investment goals and risk tolerance. If you prioritize capital preservation and a steady income stream, a passively managed bond ETF might be a better fit. However, if you're comfortable with some additional risk in exchange for the potential for higher returns, AGGH could be an interesting option to consider. Here are some key takeaways to remember. AGGH uses active management, potentially leading to higher volatility and returns compared to passively managed bond ETFs. It focuses on investment-grade bonds, offering some protection against defaults, but still carrying some credit risk. Fees associated with AGGH might be higher than passively managed options. Before making any investment decisions, be sure to do your own research and consider your individual circumstances. Thanks for joining us on Chat ETF today. Don't forget to like this video and subscribe to the channel for more in-depth ETF analysis. We'll see you on the next one.